Hey everybody, what's up? We are live. This is Mitch Goldberg. I'm here with you live, streaming live to talk to you about a couple of important things. But today, what I really want to do is I want to talk to you about gold because it is just the hottest subject. It's one of the best performing asset classes in the last year. And it's something that is sparking a lot of interest. Just whenever an asset class goes to a new high or moves up a lot, people start to get excited about it. So you're watching my live stream, Be the Boss of Your Money, your place to go for perspective and education about money, investing, personal finance, and business. We're going to roll the intro, and then we've got just a couple of things that we need to get into. Okay, and we're back. So gold is up a lot in the last year, and it's one of the few asset classes besides tech stocks and the Nasdaq that is actually making highs. And a lot of people are all of a sudden interested in it. It's getting a lot of attention, and when something gets a lot of attention for a positive reason because people are making money from it, it tends to spark a lot of interest. So should you buy gold now, or is it too late? Because gold is it's right up around where it was in 2011, about $1,900 an ounce. And my thinking is that when something breaks out after when something hits a high and it finally breaks above that high, that's usually a positive sign from a technical perspective. So you have a lot of technical analysts who are saying that. I myself am not a technical analyst. I do look at technicals to help make some buy and sell decisions, but there's a lot more other things that I look at to make any investment decision. But the most important thing is, does whatever you're doing have the right fit for your personal goals, your personal finance, like your risk tolerance, your time horizon, your goals, your financial goals? That's the important thing. So when people say, oh, we should buy gold because it's going up, yes, obviously an investment that goes up in value is always a benefit to your personal finance, but it doesn't necessarily mean that that is the right investment for you. I could think of a lot of investments that have gone up a lot, like Bitcoin. It went from 10,000 to 19,000. Does that mean it was good for you? Which now I think it just broke above 10,000 for the first time in a couple of years. So we have to just take a look. So if you're a viewer of this show, I thank you very much. If you have any questions, hit me up in the comments. When it comes to investing, in personal finance, these are subjects that I know a lot about. I'd love to share my knowledge, my information with you. I'd love to give you my perspectives. We're talking about gold if you're watching this in the replay, but I want to welcome you as well. So let's start with a quick intro, not a quick intro, the quick market update. This is always how we start our show, and it's important to take a look because we need a jumping or a stepping stone to get this party started. So today we had an okay day in the major averages. Dow is up 0.43%, up 114 points, helped make up a little bit for Friday's down day and last week's tough week. S&P up a little bit, up more than the Dow. S&P was up 0.74%, and the Nasdaq was the winner of the day, up 1.67%. The reason the Nasdaq was the winner of the day is because tech stocks led. They had a pretty nice bounce from last week. Last week, stocks got hit, including the FANG M stocks, the biggest tech stocks have all got hit pretty hard the last week, but they rebounded a little bit today. I think there was a sense of relief that these stocks didn't keep going down, because the talk about tech stocks now is they make up too big a portion of the S&P 500, and the last time they made such a big portion of the S&P 500 was in the year 2000, which ended in disaster for tech stocks. What else could we say about that? That when people are relying on too few stocks for all their gains, and that's true, people are doing that. I mean, every everyone who has anything to show for this year, whether if you're making money this year or not, or losing money this year, whatever you have that's positive is probably tech stocks, and tech stocks are holding you up. And anyway, we had the Russell 2000 up today, up 1.16%. The Russell 2000 has been on a tear lately, and that's the small cap index. Small cap index, that small cap stocks, most of which are companies you probably never even heard of, but they're more sensitive to the economy, to the health of the U.S. economy. And when small caps are going up, that means investors are actually pretty positive about the economy improving, which tells you something opposite of how a lot of people feel with the rising cases of COVID throughout the Sun Belt and California. So, and by the way, just an FYI, the news today shows that maybe Florida, Texas, and Georgia cases are starting to trend down a little bit. Maybe people are starting to wear masks, take social distancing a little bit more serious. I hope they are, and I hope this continues, this downtrend. The VIX is down 1 point. That's a good sign. That means that hedge funds, professional money managers, the type of investors that ordinarily would hedge their investments are not as worried, about the market. Let's just take a quick look at the what I want to look at are the FANG stocks. So take my word for it. The FANG stocks are all up, but XLK up 1.66. That's pretty good, up 1.58%. Then builders, real estate, communications had a good day. Communications, XLC. I follow the 11 sectors of the economy based on the ETFs that track them. So if you want to know what my main dashboard is, you're looking at it. All right. XLC, the communication sector. We're looking at the ETFs. It's just, I'm used to looking at the ETF prices to track the 11 different sectors of the economy. But XLC is half Netflix and Facebook. So, take it for what it's worth, but it's basically a tech index. XLY, discretionary. Financials were off a touch. Utilities were off a touch. Utilities are a safe haven asset. So when they go down, that means people are feeling like they want to take on a little bit more risk. Financials, I would have liked to have seen that go up today. If I could say that's the big fly in the ointment. That's the worst thing about the day. We'll just take a quick look at gold. Okay, gold was up almost 2% today. It's at 1934. Gold was up, silver, platinum, copper, palladium. By the way, the precious metals, it's very common for them to move together. If gold is moving up, you're usually going to see palladium and other stocks. So copper is not a precious metal, although it is probably the most important metal you could follow as far as gauging the economy. All right. But if you take a look real quick at gold, we'll see how quickly this screen comes up. When you live stream, it uses up a lot of resources of your computer, but we'll just take a look here. So COMEX gold, $1,934 per ounce. All right. I believe that is a year high, and I think it's like a 9-year high. Okay. So yeah, that is a new high. So we're looking at gold having a pretty substantial breakout. But here's the chart that I really want to show you, because we need to talk about gold and how best to do it. Again, folks, if you have questions about this, ask away in the comments. I'd love to see your comments. Your questions in the comments. I'd love to answer your questions. To me, that is that's like the best part of this, is when you ask questions in the comments. So let's just take a quick look. I already did not mean to make my chart smaller. Okay. I want you to take a look at this chart, because I don't know if you could see in your your small screen, but 52% in the last year versus 20%. Okay. So gold is up. Gold is up about 20% in the last year. I'm going to stop the share screen. Gold is having a really good year. But the gold mining ETF, GDX, the VanEck Gold Miners ETF, is having a much better year than the gold ETF. The gold ETF, which is GLD, tracks the price of gold in US dollars. the GDX, the gold miners ETF, just, it's a basket of companies that basically drill for gold. I want to talk to you about the pros and cons of investing in gold, and then what's the difference between investing in gold and the gold mining stocks, and why one may or may not be better for you. So here goes. The pros of investing in gold is that it's been a store of value for thousands of years. Okay, so it doesn't look like that's changing too quickly, but it's been a consistent store of value. It's been a consistent uh, use case for currency for thousands of years. Gold is a rare element. There's only a limited supply. You have to mine it. You have to find it, there's no guarantee that we ever find more gold. Gold is actually pretty rare throughout the universe, by the way. It is definitely a rare element. As much as we see gold around here, it is still a pretty rare element. Okay, some of the other things, it's also known as a safe haven. So safe haven assets I'm not talking about like safe investments, like putting your money into a money market where that's stable. Safe haven assets could still be very volatile. Safe haven asset means in times of like war, geopolitical strife, there's usually a flight to safe haven assets. And typically safe haven assets are the US dollar and gold. So if there's worries about a war, or there's something happening in the Middle East, typically speaking, you see gold spike up. But these spikes usually come right down. These enthusiasm, these short-term hits for enthusiasm, they usually wear off pretty quickly once the geopolitical event passes, and then gold just goes right back down to where it was before the event. There's not a whole hell of a lot of industrial uses for gold, but I'll tell you why gold is a very important product for the electronics industry. Gold is conductive, not as good as copper, but gold doesn't corrode. It's very difficult to break down gold because it's already broken down to its most basic form, because it's an element. So it holds up better than copper. It doesn't erode. It's not as corrosive. So gold is pretty important for electronics. So that's pretty much the best industrial case that I could think of. The negatives for gold. Well, let me get into the main reason to own gold. I think one of the best reasons to own gold, and this is why we follow gold in financial markets, mainly why we follow it in financial markets, is because gold is known as a hedge against inflation. So when we see inflation, typically gold will go up in value, and it could go up in value pretty quickly. And if investors think inflation is on the way, they would send gold up in advance of inflation. Now, from a monetarist point of view, the Milton Friedman monetary definition of inflation is too many dollars chasing too few goods. If you think in terms of all the money printing that's been going on with the Federal Reserve, the United States, and in Europe, all over the world, really, that we still have a lot of money printed that we didn't take back from the Great Recession 11 years ago. Even more money is being printed now to help fight the pandemic and keep the economy going. Investors are worried that there's too many dollars and it's going to be inflationary, and it's devaluing fiat, or man-made paper currency. Okay, currency is that's man-made, and then there's currency that's man-made, and then there's currency like gold or wampum, which is shells. Okay, so there's all kinds of currency, but the currency that we go by is paper money. Be it in electronic form or coins, we go by paper money, the fiat currency. So we're printing so much money that some investors may be thinking that we are going to have inflation, and we need to get ahead of that by buying gold now. I really think that is what is one of the two things pushing up gold. The second thing that's pushing up gold is just that it's going up. So if investors see that it's going up, they want a piece of that action, and they think, well, somebody must know something. Let's try to think of the reason why gold could be going up, because there's coming or inflation, because of inflation expectations. So it's one thing to be ahead of inflation. It's another thing to think that gold is going up because inflation is coming. So we don't know if there's going to be inflation or not. I mean, so far, inflation has been pretty elusive for like the last 12 years or so. In fact, the Federal Reserve and other central banks do want some inflation. They're looking for typically about 2% inflation. It's just enough to keep prices rising, barely enough to hurt demand, but enough to show strength of an economy and to keep things like sales taxes and other things growing. Okay. Um, Deflation is a sign of a weakened economy. So anyway, I want to. I don't want to digress too much. The cons of gold, though, is when a geopolitical event does go away, gold usually goes back down. Gold is also a very volatile investment. Okay, gold is not to me a currency. I mean, think about this. If you need like a chip of gold to buy a loaf of bread at the supermarket, we're going to have much bigger problems than missing out on gold as an investment or inflation. And we're going to have really big problems. So I don't think gold is really as functional of a currency. I mean, people don't walk around with gold coins in their pockets. I'm not saying you can't invest in gold coins, or I'm not saying people don't enjoy collecting these things, but we're not using gold, and we're not going back to that silly gold standard. If we went back to the gold standard, we'd set the economy back by about 50 years, and we'd probably would just crush the value of the dollar. And it would, you need like a wheelbarrow of money to buy a gallon of milk. It's not feasible. When people go on with the gold standard, it's like they're in La La Land. There's a complete missing of math when you hear people say we should go back to the gold standard. The gold standard basically said that however much gold we have is how much currency we could have, how much dollars we could have. But what happens is you don't get growth of credit. You don't get growth of the economy because you're limited to just the amount of gold you have. So Nixon in 1972 took the U.S. off the gold standard. We were already getting off the gold standard, but that we put the final kibosh on it. And ever since then, the economy, the modern economy has really been able to grow. Now, I'm not saying people haven't gotten carried away with it and taken on too much debt, but the point is, if we were all stuck with the gold standard and we only basically were worth the gold we had in our pockets all of a sudden, I think most of us would be in pretty bad shape. We don't want the gold standard. Okay, enough of that. So gold is an inflation hedge, and that to me is the best reason to own it. There are other things to own though for an inflation hedge. There are things like real estate, stocks, oil stocks. If there's inflation, it might not just be in the price of, well, gold is really supposed to be a reflection of inflation and a hedge against inflation. It's not meant to be a leading cause of inflation. If gold is going up now and we do get inflation, it's not because gold is causing the inflation. It's more like gold predicted that we would eventually have inflation. All right, so that's my take on it. And then you have gold mining stocks. Gold mining stocks could do a lot better than the price of gold, and I'll tell you why. Gold miners spend a certain amount to mine gold, and the lower the cost of a gold miner to get gold out of the ground, let's say it only costs $100 an ounce. If a gold miner gets gold out of the ground, it's $100 an ounce. Gold right now is $1,900 an ounce. 1,900 minus 100, that's a big profit. But if a miner is going to have to spend $2,000 to get an ounce of gold out of the ground, that gold miner is losing money. But gold miners have spent years getting their costs down because gold has been such a weak performer for so many years. And now a slight uptick in gold means that the mined gold is all of a sudden much more profitable. It's like instantaneously more profitable. So if it's instantaneously more profitable, you would see gold mining stocks, which are very leveraged to the price of gold, obviously they would go up. So meaning the lower their cost for the price of gold, or the bigger the spread is between between a gold miner's cost of extracting gold from the ground and the current price of gold, the bigger that spread, the more profitable a gold miner would become. So as gold finally goes up, and it's doing well, but the earnings of the gold mining ETFs go up a lot faster than just the price of gold. That's what I mean by gold miners are much more leveraged to the price of gold than gold itself. Now, if you had to pick one or the other, I'm going to say that with gold doesn't pay a dividend. It does cost money to store. Like even the GLD ETF does have an expense ratio, but it is a very easy, cheap way to invest in gold. It's the most popular way for investors to invest in gold. Gold mining stocks are a double-edged sword. When gold is going up, gold mining stocks can do extremely well. When gold is going down in value, gold mining stocks could do extremely poorly. So you have to decide as an investor, do you want gold as a hedge against inflation and it'll help protect your money because at least you have something going up while your money is going down? Maybe you want it as part of your investment portfolio as a diversifier. And those are all legitimate reasons to own gold. Or do you want to own the gold mining ETFs like Van Eck is GDX is the popular gold miners ETF from Van Eck. GDX is the symbol. You could own that and do very well with that if gold keeps going up, just because gold miners, their earnings and profit margins grow as gold goes up. But it's a double-edged sword, so you have to be able to have the stomach for the risk if there's a reversal, and gold miners could go down pretty quickly as well. So that's basically it. You have to decide if you want gold to begin with, and then you have to decide if you want GLD, the gold ETF, or if you want a gold mining ETF like GDX. What should you decide this on? You should really decide this on your risk tolerance, your time horizon, your goals, diversification needs. Those are the kinds of reasons that I would invest in gold, that I would recommend it. I do have clients who are invested, who have exposure to gold, but it's not across the board, and I don't think it's appropriate for every single client. I just think that you have to decide if it's something you want in your portfolio. Stocks in general are known to be a good hedge against inflation, and so is real estate. So gold is by far not the only way to hedge yourself against inflation. But the real driver for gold right now, I believe, is inflation, because currency is becoming worth. If you notice, the US dollar against a basket of currencies has been on a pretty major downtrend lately. So that's really, to me, the ultimate driver of the price of gold. All right, so I'm going to get going now. I'll see you tomorrow, and I hope this helps you out with your understanding of gold. I'll speak to you soon.